You can't keep a good stock market down. Or can you? That's the question that we're going to be asking ourselves today as the U.S. session winds up with another cautious rise for Wall Street. And the markets look ahead to another busy calendar of economic data ahead. We are looking here at a market that seems to be in transition, seems to be defying the limits that it put on itself in the preceding 2 months and deciding that even those conditions that investors might have thought worrying just weeks ago don't really represent much of a risk and don't really hamper stock gains. So what we're going to do here today is take a look at what is it that seems to be inspiring this resilience, how it is that we've arrived at it, why it might be under threat going forward. So the question, as ever, centers on the U.S. economy and whether we've truly ducked what was a threat to economic growth, and if, in fact, we are already on a path to a soft landing as the markets would have us thinking. So first, let's have a look at a familiar chart here that we use to track what it is that the markets care about and what seems to be driving them. And we can see here in no uncertain terms that there is the period from mid-2023, and then there is January. And there's a clear distinction between the way the financial markets seem to operate now in contrast to how they were going about defining where they're heading in the 6 months through the second half of last year. Now, we can find exactly what's going on with a very sort of easy way of looking at U.S. stocks, which might as well be a proxy for global stocks here because the MSCI World Stock Index and the S&P 500 look nearly identical. That, of course, shouldn't be shocking if the U.S. stock market is by far the largest and by far the deepest, and it is U.S. companies, in particular in the tech sector, that are powering the entire pie. Well, it makes sense why, when you average everything together, it is the U.S. that sets the pace. So looking at what we've been seeing here in the S&P 500 as a kind of barometer of global equity market sentiment and global risk appetite at large, we can essentially see here that we have a period where we enter the new year much with the same policy settings as we had at mid-year. And at mid-year, they were crisis-inspired. This was the amount of cuts the markets were anticipating to see in 2024, just in the wake of the SVB-led banking crisis, just as the leaders in Congress were grappling with yet another debt ceiling debacle. And so what you had here was a situation where, as of July, you were looking at 6 cuts being baked in for 2024, much the same as you had at the start of this year. Then, as the number of rate cuts started to diminish from the outlook, as it looked like the debt ceiling deal was done, the regional banking situation was ring-fenced by swift Fed action, the level of emergency was very clearly receding here. And so we shaved basically 3 cuts over the course of July and into sort of late September, October. And we can see the reaction from the markets very clearly, very unambiguously, was negative. S&P declined. This spoke to a broader risk-off dynamic across most financial markets. And for very simple reasons. If credit is going to look like it's more expensive than people thought, well, then financing any and all kinds of economic activity the world over is going to be more challenging. And of course, if stock markets ultimately reflect expectations for earnings, then we are going to see, with a rising cost of credit and a rising cost of financing global economic activity, a diminished outlook on people's ability to buy things, on companies' ability to buy things, and so on those companies that might sell them those things, their ability to generate earnings naturally is hurt that way. And so stock valuations came in. As the Fed started to signal that perhaps inflation has been adequately pushed back on and the peak in the rate hike cycle has arrived, we started to see that dynamic inverse and go the other way. So we now start to see more rate cuts build out and stocks soar. That was the sharp rise that we saw in November and December. And as we saw rate cut odds kind of stabilize here, so too did stocks. Now January, right here. This is shaping up to be something fundamentally different, something very much other than what we were looking at before. So consider here, this range has been clearly broken. So whatever stocks were feeling right here as they were figuring out what to do about these peaking rate cut odds, they seem to have resolved it with a clear break higher. Now, what's especially interesting about this is that this has come at the same time that the stock of rate cut expectations has diminished. And so the inverse relationship has broken down. Bond yields are going up. The amount of rate cuts in the outlook is diminishing, but stocks are powering higher all the same. This is a fundamental change in the makings of this entire situation, and can really only work if a pair of conclusions, if two conclusions can be taken as baseline assumptions. The first one is that, in fact, inflation is at this point adequately curtailed. And indeed, that's why we're getting cuts. So to believe that there are cuts that are coming, and at this point we're still looking at 5 of them in the outlook, about 124 basis points in cuts amounts to 5 cuts over the course of this year. If you can do cuts, that means you have gotten inflation on a path to 2%. The second is that you actually don't need a tremendous amount of them because the global growth situation is relatively benign. That you don't need 6 cuts in order for stocks to go up. That you can actually trim that back and stocks can still rise because whatever's going on with global growth is ultimately not terribly negative. Now, it is this part of the assumptions underpinning what's going on in markets now that we are going to see challenged over the next 24 hours. If we look at where global growth is at the moment, what we find is indeed it has been improving a little bit over the past 2 months. So if we look here at these global PMIs, these are as of December, we can see that all the way from a year ago, and even before that, global manufacturing has been in contraction territory. This is as ever in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. So what we're looking at here then is a situation overwhelmingly powered by the service sector. And what you can see here is that indeed, over the past 2 months, a perking up of the service sector globally has helped to lift performance. Now, we're still below the 12-month average. So this is not growth that's terribly fast, nor is it even baseline, but it is an improvement. So there is some logic to saying that the global economic landscape has improved modestly, but nevertheless, over the past 2 months, over the course of November and December. And indeed, inflation expectations are coming in, whether we look at break-even rates or swap rates or the Cleveland Fed's measure of market-based inflation expectations, which is a composite of various indicators, including swaps data, survey-based measures, treasury yields, etc. All of that data suggested that indeed over the course of December, inflation expectations fell, and starting January, they're tracking significantly better. At this point, the 1-year inflation expectation at 2.4, the 2-year at 2.3, 3-year at 2.2. So it does look like the Fed is well and truly on track to get to where it wants to go. So seemingly the makings of what the markets are anticipating here are in fact there. So now we're going to see what all this looks like in January. And this is where things get interesting. Over the next 24 hours, we are going to get updated numbers. We've already seen them for Australia just over the course of yesterday. And we can see that what we have for the composite number here, expectations had it just about right, it looks like, for the tone of these releases. Australia continues to shrink, of course. You can see the actual number here, 48.1, right in line with forecasts. But and that is an improvement over the 46.9 from December, but that it's below 50 tells us that we are still in contraction mode. Now, over the course of this next day, we're going to get Japan, we're going to get Germany, we're going to get the Eurozone and the US. And it's the US where things get especially interesting. But first, consider, in Japan, we have an economy that is at standstill as of January, right at 50, or as of December, rather, right at 50. The expectation is we're going to go to 49.5. So a slight contraction, but basically the same standstill, give or take. Germany, expected to go to 48.1 from 47.4. Another contraction for Europe's largest economy, but at a slower rate. The regional measure, very similar sort of thing, from 47.6 to 48. So a slower contraction, but a contraction nevertheless. Likewise, in the UK, we're looking at the composite still giving us growth, slightly faster, but the collective story here for all of these seems to be none of these economies is going anywhere fast. And in the case of the sort of key inputs into global growth, when we consider that the Eurozone alone is about a fifth of the global economy, the overall inputs seem relatively stable in terms of what we're looking at here. Until we get to the US. Now, if we look at the expectations for US performance, here we are looking at downswings. A downswing in the service sector, a downswing in the composite to follow, and of course, manufacturing is still in contraction as elsewhere. Now, if we consider that the US is about a quarter of global GDP, the Eurozone is another fifth. China makes up the rest of the first 50%. So between the Eurozone, the US, and China, you have 50% of global growth. We're not going to get numbers on China for the PMI data set this week. That comes next week on Wednesday. But from the looks of it, China has been about the same version of anemic really since they opened, and about 2 months after, just about a year ago now. So they reopened from COVID restrictions in December of 2022. We are now looking at a situation that very closely approximates where that reopening, after an initial jump in economic activity in January, February, going into March, once that crested in March and the economy unwound back down to near standstill, that's about where we are. And that's about where we've been throughout most of last year. And that is because China has lost critical market access and critical market share because it was locked down for so long, and because there was an impetus for its main export markets to shift supply chains. So when we look at the overall story then, what we end up seeing is a situation where China is anemic, the Eurozone is in recession, but the overall global pie is improving. Why? Well, ostensibly, it is because the U.S. has had a little bit of a pickup in November and December. Modest. We can see that since August, we've really hugged that 50 line, so very close to standstill. But there is just a hint of an upside incline here. And so the resilience that we've seen in global growth, and therefore this idea that we're going to get this soft landing, seems basically to hinge on U.S. demand continuing to buck the trend globally. And the expectation from this PMI data will be that actually U.S. growth will have slowed. 50.3 would be the weakest reading in 4 months since 50.2 in September. So we're looking at a situation that ultimately gives us a potent challenge to this idea that global growth can continue to buck recession, because if it's the U.S. that is the main source of resilience, if the global growth stool basically is at this point standing on one leg, then to see that leg begin to look shakier than the markets are anticipating would suggest that, in fact, the underlying premise of what's keeping stock markets elevated here is going to be challenged. Now, it certainly doesn't help that through all of this, as we look at the way that global economic data, both in developed and emerging markets, has been performing relative to forecasts. This is data from Citigroup. So we look here, we see that it has been deteriorating all through November and December. Part of that, almost certainly, is that this rosy perspective of global growth has actually nudged up the expectations themselves. And so the data is having a harder time beating those expectations because the markets have become more optimistic. But now it looks like all three of these indices have basically settled on just about zero, suggesting that current outcomes are right about in line with what the global economy is turning up. And that is, of course, an encouraging thing. It suggests the markets have the global business cycle pegged just about correctly. But it also suggests that everything is at this point just about priced for perfection until something changes. Well, and that very something may be a challenge to the underlying idea that the U.S. can remain a bulwark against recession. On top of the PMI data, a further nudge in this direction comes from the Bank of Canada, which is also set to have a monetary policy announcement in the next day. Here we're looking for stasis, as we can see here, rates in Canada expected to remain unchanged through most of the first half of the year here. 3 months out, you can see rates expected to be just a touch lower, so from 5 down to 4.89%. That implies a slight, close to negligible probability of a cut within 3 months, but really it looks like that cut comes within 6 months, because we can see 6 months out, we're looking at a rate of 4.63, implying we've already had a 25 basis point cut at that point, and we're starting to angle maybe towards a second. By the end of the year, you can see we're at 4%, so the markets are now baking in a full percentage point in rate cuts from Canada. The policy announcement this time is going to be more about stage setting and messaging. Well, what can that messaging be when, if you look at Canada's PMI data, that economy has seen economic activity shrinking for the past 7 months? We'll see what happens with January's numbers, but clearly this is not encouraging. And as of December's report, to kind of add insult to injury, looking at the internals, what we find is that new orders have fallen by the biggest margin since mid-2020, right at the heart of COVID. Now, if Canada's economy is fizzling because new orders are unraveling and businesses are not finding demand, surely that's a reason why the central bank might come out with a dovish tone. They might start to sound as though they are laying the groundwork for perhaps sooner cuts that might shift these curves. But more dramatically still, looking outside of Canada, it's important to remember where new orders in Canada would come from. Indeed, close to 80% of Canadian exports are U.S. bound. So what that means is, if there's not new orders growth in Canada, U.S. demand is weak, and perhaps weaker than the markets are appreciating. And so over these next 24 hours, what we're going to get is ostensibly a Bank of Canada that sounds worried, that starts to construct the dovish infrastructure for cutting rates because the economy is as hampered as it is, and perhaps even signal more overtly that the reason the economy is so hampered is because the U.S. demand picture, as it were, for Canadian firms has significantly deteriorated. At the same time, we're going to get this PMI data giving us U.S. activity growth at its slowest in 4 months. And naturally, then, the question comes, well, if the underlying logic for what is going on in these markets is that we don't need aggressive rate cuts because growth is going to be okay, and we still need some of them because inflation is beaten. Well, the inflation piece may well be true, but the assumption on growth and the cost of making that victory over inflation true may not be quite as low, and the situation may not be quite as painless as the markets are now seeming to imply. Because if, in fact, it is the U.S. that is the critical underpinning here, and with the Eurozone in recession and China in an anemic state, there really isn't anything else. And then we get data suggesting the U.S. isn't as strong as perhaps the markets are anticipating, well, then a key part of the underlying logic keeping stocks afloat here crumbles. Now, will the markets care is an altogether separate question. They may not. Markets can remain irrational longer than we can remain solvent, to paraphrase a quote often attributed to John Maynard Keynes. But nevertheless, what we are going to get is, at the very least, the data underpinnings for which part of the market may be coming under pressure, for which part of the market's overall logic looks suspect. That doesn't mean that things are going to unravel in the data's immediate aftermath. But what it does suggest is we are on the cusp of getting the kind of evidence that brings the threat of global recession closer. And if that's what ultimately occurs, and the markets opt for complacency, then the violence of whatever reckoning comes eventually to reconcile these disconnects is likely to be greater. The further you stretch the rubber band, as it were, the harder it's going to snap back. And so one way or another, reflective in price action or not, the numbers that we are looking to seeing here may ultimately be the tell that we need to signal whether what's going on here is sustainable, at least for now, or whether it's operating on borrowed time. And that is Macro Money for today. As ever, we are here right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radican Monday through Thursday. Looks at what's going on Wall Street and looks at what that might mean going forward. Back on with Chris for Futures Power Hour on Fridays. On with Tom and Tony for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. We'll be back tomorrow. Take care.